Silver didn't just bounce, it detonated. From $65 to nearly $78 in a single day. Bitcoin ripped more than $11,000 higher in hours. Over $1 trillion flooded back into US stocks almost instantly. And while most people were still mentally stuck in yesterday's crash, the markets had already flipped from panic to risk on. This wasn't a relief rally that quietly tiptoed higher. This was violent, synchronized, and impossible to ignore. Here's the part that should make you uncomfortable. None of this showed up the way you'd expect in the headlines. No breaking alerts explaining why silver suddenly surged over 20%. No serious discussion about why crypto added hundreds of billions in market value in a single session. No deep dive into how stocks didn't just recover but pushed to new highs. That silence matters because this kind of move doesn't happen randomly. It happens when leverage breaks, positions get forced out, and capital rushes back in all at once. Let's start with silver because it tells the cleanest story. Just hours earlier, silver was trading around $65, the lowest point of this correction. Sentiment was destroyed, fear was everywhere. Then, almost without warning, price reversed hard. By the time most traders even realized what was happening, silver was already up more than 20%. That kind of move doesn't come from retail buying a few coins. It comes from paper positions getting wiped out and physical demand quietly tightening underneath the surface. At the same time, Bitcoin staged its own violent reversal. After weeks of selling pressure and a sharp drop from the highs, Bitcoin surged back above $70,000 in a single day. Ethereum followed, reclaiming key levels, while hundreds of millions of dollars in short positions were liquidated. In less than 24 hours, the crypto market added hundreds of billions in value. That tells you one thing clearly. Capital didn't leave the system. It was waiting. Stocks confirmed it. The major US indexes didn't just stabilize, they erased losses aggressively. The Dow surged to a fresh all-time high. The S&P and Nasdaq fully recovered from the prior day's decline. Even more telling, small-cap stocks jumped faster than large caps. When smaller companies lead, it's a signal that investors are rotating back into risk, not hiding from it. This same pattern has repeated again and again throughout this year. Sharp sell-offs, panic headlines, then sudden explosive recoveries. At some point, you stop calling it normal volatility and start calling it what it is. A market dominated by leverage, liquidity shocks, and positioning rather than slow, orderly price discovery. Now here's the key question everyone wants answered. Did we just see the low in silver? To answer that, you have to stop looking only at price and start looking at structure. One of the most important signals right now is the silver lease rate. Short-term lease rates jumped above 6%. That number matters more than most people realize. High lease rates mean one thing. Physical silver is tight. If silver were abundant, if supply were loose, no one would be paying a premium just to borrow it. Elevated lease rates tell you that while paper selling was being flushed out, physical demand never collapsed. Silver is also still trading in backwardation. That's another red flag for anyone betting on a sustained breakdown. Backwardation means immediate demand is stronger than future supply expectations. In plain English, people want silver now, not later. That's not what you see in a market drowning in excess metal. Futures data reinforces this picture. Open interest in gold futures recently fell to levels not seen since late 2018. That kind of collapse doesn't happen during healthy speculation. It happens when traders are forced out, when leverage is removed, and when weak hands are cleared. Historically, those moments tend to occur closer to major lows than major tops. As price stabilizes and confidence returns, open interest expands again as participants re-enter. China adds another critical layer. Silver inventories on Chinese exchanges have been draining for years, and the pace has been relentless. Since 2020, thousands of tons have been pulled out of storage, representing the vast majority of those reserves. Even now, large daily withdrawals continue. At the current rate, it wouldn't take long for those vaults to approach empty. China is one of the largest consumers of silver in the world, and historically, Chinese buyers step in hardest when prices fall. Weak prices don't scare them away, they attract buying. Geopolitics only complicates this further. Rising global tensions reintroduce risk premiums into markets, and precious metals tend to benefit from that shift. Gold's long-term structure remains intact, and silver, while more volatile, often follows with greater force once momentum turns. Zoom out far enough, and the recent pullback in silver looks very different. When you adjust for decades of monetary expansion, this move resembles a retest of a broader breakout rather than a failure. Prices haven't even challenged the extreme highs from the early 2010s, yet sentiment collapsed as if the entire bull case had died. That disconnect between price and psychology is often where opportunity forms. Silver miners are another piece of the puzzle that's been largely ignored. Historically, miners don't just track silver, they amplify it. In past bull markets, silver might rise a few 100%, while major mining stocks rose several multiples of that. This time, miners lagged badly even during silver's earlier surge. The reason is simple. Analysts were still modeling profits based on outdated price assumptions. That's about to change. As miners begin reporting earnings based on much higher realized silver prices, the numbers will force a reassessment. Cash flows at current levels are dramatically higher than what many valuations reflect. Once that reality hits, upgrades tend to come fast, and when miners move, they rarely do it quietly. There's also a hard structural limit most people overlook. Banks don't have infinite balance sheets. Paper markets can suppress prices temporarily, but they rely on leverage. When physical demand overwhelms paper supply, balance sheet constraints matter. That's when repricing happens, whether the market is ready for it or not. Which brings us to the looming issue in the silver futures market. In the coming weeks, a massive amount of open interest is set to confront a much smaller pool of registered inventory. Even under conservative assumptions, supply looks tight. Under more aggressive but historically realistic delivery scenarios, the numbers look outright strained. If a significant portion of contracts stand for delivery, available inventory may not be sufficient. That's how stress events begin. At the same time, it's critical to stay honest about risk, especially for those watching Bitcoin alongside metals. Bitcoin has a long history of deep drawdowns during bear phases. While each cycle's decline has become progressively less severe, substantial volatility remains normal. Based on historical patterns, there is still room for further downside before a definitive long-term bottom is confirmed. Because silver often reacts to broader risk sentiment, sustained pressure in Bitcoin could still impact metals in the short term. That doesn't invalidate the move we just saw. It means confirmation matters. Violent sell-offs often lead to violent rebounds, but not every rebound marks the end of a correction. The next phase is about whether prices can hold, build a base, and attract steady demand rather than just fast money chasing momentum. What's encouraging is that many structural indicators are flashing signals associated with exhaustion of selling pressure. Elevated lease rates, persistent backwardation, washed out open interest, ongoing physical inventory drawdowns. These are not signs of abundant supply. They are signs of paper leverage being flushed while physical tightens. So where does that leave us right now? We just witnessed a rapid return of risk appetite. Silver surged more than 20% from the lows. Bitcoin reclaimed key levels. Stocks erased losses and pushed higher. Short positions were liquidated aggressively across markets. At the same time, longer-term technical and historical patterns remind us that volatility is not over. The next few weeks will be decisive. Futures delivery dynamics, physical inventory trends, and Bitcoin's behavior as a risk indicator will determine whether this was the true low or just a dramatic pause in a larger correction. For anyone watching the Iraqi dinar space, precious metals, or global capital flows, the takeaway is the same. Zoom out, follow the data, and don't let emotion drive decisions. This is a high-stakes environment. Moves Moves will be fast, narratives will flip overnight. But when you strip away the noise and focus on structure, supply, demand, and balance sheets, the picture sharpens. Strength doesn't come from certainty. It comes from understanding. And right now, understanding the difference between paper volatility and physical reality matters more than ever.